Hey, good evening, everyone. Marty Mazzora here, Thursday, 26th of October, 2023, with your end-of-week market snapshot. I'll follow up, as usual, with a commentary on the economy, but this weekend I think it'll probably come to you later on Sunday. So I will talk at you for a minute or three, kind of about how we see the latest developments, and I'll let you know when I'm switching over to the technical analysis for those of you who would rather stop at just my brief narrative. And I do think I'll be able to keep it brief today. So trading more or less, I think, comports with what we've been looking at in the technicals. As you know, regular watchers, we believe that the downside risk is significant, that the risk of breaking below the last October low of 3,500 on the S&P 500 is significant. And as I've said a bazillion times, the next leg down, in our view, will reflect lower earnings that virtually have to come during a recession that are utterly not priced in the market right now. The market is priced for no recession going forward and ever rising earnings. So this correction, though, I will say that we've had disappointing earnings, but for the most part, the market has been rolling over on better than expected data, generally stubborn inflation, and central bank commentary that says you can forget about a rate cut, you may not get another hike, but as Chairman Powell said last Friday, essentially monetary policy is anything but too tight right here. And that's got the market fearing, stubbornly high interest rates, stubborn inflation, and therefore lower stock prices. I've maintained that when it becomes clear that the economy is weakening, that stocks initially will probably rally on that. Hence my view that this probably isn't the correction to take us to levels where we would meaningfully start taking positions that we're looking at for the next bull market. It makes more sense to us that the economy begins to weaken, folks anticipate a softening central bank, and we get a rally. Then when the real world hits and we're going to have a recession, then stocks roll over and we get that last leg down in the bear market. So those of you who stick with me, as you're going to see here over the next few minutes, technically, the market looks like it's ready to bounce right here. And this is a rally that we're anticipating that is ultimately to be faded, but it could take us through the end of 2023 if we do get it. And tomorrow's PCE data, if it comes in at all soft, that's really going to give the oomph for a pretty nice bounce. If it comes in hot, though, this thing rolls over even further and we plumb some lower lows that I'll talk about here when we get to the charts. So folks, those of you who don't want to stick with me through the charts, thank you so much for watching and listening. Catch you next time. For the rest of us, we'll go ahead and start with the one I have up there. This is the 60-day, 60-minute chart of the S&P 500. This looks really bullish to me, particularly if we turn up tomorrow. And this is what we were looking at in our strategy meeting this morning. So this is a bullish look. Oversold on the hourly chart. Positive divergence, particularly if we open up strong in the morning, and that's going to set the stage for a pretty good rally. I mean, I could see us popping back up here really quickly to 4,200, then 4,300. The daily though is interesting. We have a bear flag pattern that is played out pretty much perfectly the way bear flag patterns tend to, and just to zero in on that for you. So just march right down to 4103 would be where, and you can see lots and lots of congestion right in there, where you'd get some pretty good support. I think traders are front running that a bit. And again, just look at that congestion zone in there, and you can see that's virtually right where the market stopped its decline today. So, it could be just a day or two bounce, and then we play that out. I'd be surprised if we don't get a decent bounce off of there. Remember, I first flagged 4,200 right here. Danced around the 200-day moving average, gave it up. It became resistance right around that 4,200 mark. And I said there's a pretty good air pocket between there and 4,100, but looks like the top of all this action right here may be where we pause and get a bounce here. And that's just how it looks. Of course, could be wrong. Like I said, there's enough data tomorrow that if it comes in, quote, hotter than expected, well, then we could be right down through there, lickety split, and then I think probably finding some support down here a bit lower. On the all-important QQQ, or the NASDAQ 100 index, the ETF that tracks it, I pointed to some support at the 200-day moving average. And then if you break that, there is very little, if anything, that would stop us before we get to 320. I couldn't imagine that right here we wouldn't see some pretty strong buying, unless, of course, we get data that becomes very bearish for the market. And that kind of data today would be continuing better than expected economic data, hotter than expected inflation indicators. And then we have the Fed meeting coming up very soon as well. And their tone is going to set the tone for stocks in the meantime. Let me just repeat myself again. Ultimately, though, what gets us down to levels below last year's lows is going to be weak data, weak earnings, and people realizing that stocks are way overpriced relative to the kind of earnings results that we see during recessions. And then on the yields, very, very important, very influential when it comes to stock market action. And we're living within this upward, it's really an upward wedge, kind of a channel, I guess, if I want to do this. Momentum says that we're going to break below this. That's what our indicators would suggest. And so if yields do come down, and that coincides with the dollar coming down as well, which is definitely what our technical view of it is here, then that's going to be pretty bullish for stocks. So there's the stock market technicals, which I've shown you. There's the 10-year yield technicals, which I just showed you. And then there's the dollar technicals here, that if these patterns go the way the momentum and the pricing action suggests that they might in the near term, those are bullish factors for stocks. And then get ready for a very difficult first half of 2024. Folks, I'll stop there. Thank you, as always, for watching and listening. Late this weekend, you'll get the economic update. Take care. Bye-bye.